So you've just woken up. Your brokerage app is showing that ticker WOW is halted. 9:30 rolls around and suddenly the price is jacked up 2,500%. Jackpot. Naturally, you start shopping for your first Lambo, and after picking out the proper color and interior and specs, you check your favorite social media stock trading site and see reverse split plastered everywhere and mentions of your gains are not real. What's going on here? Does that mean no Lambo? You've just become the victim of your first reverse split. So what is a reverse split? And more importantly, how do you trade a reverse split? In order to explain reverse splits, we first need to define a few terms. First, authorized shares. This is the maximum number of shares a company is legally allowed to issue, as stated in its corporate charter. Think of it as the company's stock supply ceiling. It doesn't mean that all these shares are in circulation, it's just the upper limit. Outstanding shares are the shares that have been issued by the company and are currently held by investors, including individuals, institutions, and insiders. These represent the actual ownership of the company. Float shares, or colloquially just the float, refers to the number of the company's shares that are available for public trading on the open market. These are the subset of the outstanding shares, excluding any shares held by insiders, employees, or other stakeholders who may have restrictions on selling their shares. For instance, employee stock option plans or shares held by major shareholders. A reverse split is when a company reduces the number of its outstanding shares, effectively combining several shares into one. For example, a 1-for-10 reverse split means every 10 shares owned by investors becomes just one share, but each share becomes 10 times more valuable at the moment of conversion. This is a synthetic price change and lowers the stock liquidity. So what is liquidity? Briefly, a liquid stock is a stock where an investor can buy or sell shares without significantly moving the price. We'll cover liquidity in a future video. Note that a reverse split does not change the market cap of the company, at least in practice. Let's cook up an example. The company Gravity Analytica trades under the ticker GRAV. GRAV has an authorized share count of 100 million shares, and an outstanding share count of 80 million shares, and a float of 60 million shares. It's currently trading at 85 cents. That gives it a market cap of $68 million. That's 80 million outstanding shares times 85 cents. On October 1st, GRAV announces its stock will reverse split 1-for-10 on October 2nd. On October 2nd, the reverse split day, GRAV's outstanding shares will decrease by a factor of 10, from 80 million to 8 million. All common shareholders of GRAV will see their holdings decrease by a factor of 10. So if you're holding 12,000 shares, your account will now have 1,200 shares. Your 12,000 shares at 85 cents were worth $10,200. That's 12,000 shares times 85 cents. After this split, they are still worth $10,200. 1,200 shares times $8.50. The float also decreases by a factor of 10 from 60 million to 6 million shares. The market cap of GRAV also stays the same, from $68 million, that is 80 million shares times 85 cents, to $68 million, 8 million shares times $8.50. But what about the authorized share count? Generally, the authorized share count remains the same, but not always. It depends on the term of the reverse split. But the nuances here deserve a full video into the subject. Let's assume for this example the authorized share count remains 100 million. That means the gap of outstanding shares to authorized shares went from 20 million, that is 100 million authorized shares minus 80 million outstanding shares, to a staggering 92 million. That's 100 million authorized shares minus 8 million outstanding shares. That means the company can now sell even more shares, since the authorized share count is the upper bound of what they can sell. So why would a company choose to do this? There are a few main reasons. First, compliance. To avoid being delisted from major exchanges like the NASDAQ, companies need to maintain a minimum share price. A reverse split can boost the price above the required threshold. The NASDAQ requires listed companies to maintain a minimum closing bid price of $1. If a stock stays below $1 for more than 30 consecutive trading days, the company gets a warning. To regain compliance, they have 180 calendar days to fix the issue, and often a reverse split is their go-to solution. The 180 calendar day count starts after the 30-day warning, so basically they have around 210 days below $1 before they are delisted. To regain compliance with the NASDAQ's minimum bid price rule, a stock must close at or above $1 for at least 10 consecutive trading days during the 180-day compliance period. Second, attractiveness. A higher stock price can make the company look more appealing to institutional investors. Many institutional investors can't or won't buy stocks less than $5, and a reverse split can put their share price above this threshold. Or the company is a scam, and they're in a share selling business. After a reverse split, the gap between the number of outstanding shares and authorized shares increases. This gives the company the flexibility to issue additional shares in the future to raise capital, issue employee stock options, or fund acquisitions. So now you should be able to understand graphs like this, or this, or this, where the price in the past is ridiculously high, sometimes as high as $10,000 or $20,000 or more. These are stocks that have gone through many reverse splits and are usually dilutive pump and dumps. Buyer beware. So how do you trade reverse splits? You don't. Seriously, if you're a beginner, just don't. But if you must, the best play is to front run the dilutive run-ups. Think XTIA or UAVS. Check out our Substack for more details. We'll be covering this topic in a future video. All right, that was your quick and dirty introduction to reverse splits. Hopefully you learned something. You know the drill. Like and subscribe. And if you find this information useful, be sure to check out gravityanalytica.com. And remember, when you get to the fork in the road, take it.